It is time for your August mortgage market update. We're going to go over exactly what's been driving rates, what happened in the economy last month, and what you need to watch for over the next 30 to 60 days. So I'll be honest with you, July was one of the most consequential months for this market that we've had in a long time. We had a Fed decision, a GDP report, a major inflation print, and now the question of a potential rate hike in September is sitting front and center. So there's a lot to unpack. So let's get into it. Now let's start with rates where they're at today, the first week of August. So the 30-year interest rate is, the 30-year fixed interest rate is trading in a wide range right now, depending on your lender and the data source that you're looking at. Now, bank rate is showing around 6.78% on a conventional purchase. Zillow's marketplace is closer to 6.65, and the US News Zillow data clocked rates spiking toward 6.93%, with 30-year refinance rates briefly crossing 7% for the first time in a while. The 15-year fixed is sitting right around 5.95% to 6.03%, while a 5-1 ARM is hovering right around 6.2%. So what that tells us is that rates are at or near their highest point of 2026. The 52-week low was 5.9% back in late February. So we've climbed nearly a full percentage point from that floor, and it happened fast. So to put that in real dollars, on a $400,000 loan at 6.625% interest, your monthly principal and interest payment is around $2,568. A year ago at the same time, rates were nearly identical, right around 6.62%. So if you've been waiting for the market to improve since last summer, this is a sobering reality check. So let's talk about the three forces that are pushing and pulling rates right now, because understanding why matters more than just watching the numbers move. So force number one is the Iranian conflict and the oil prices. So when the U.S. and Israel engaged Iran in late February, oil prices surged. Oil feeds directly into inflation. It costs more to manufacture goods, to ship them, to heat homes. More inflation means bond investors demand higher yields to compensate, and that pushes mortgage rates up. Oil briefly pulled back in June when tensions eased, but renewed fighting in July has pushed prices back up more than 20%. This is the single biggest wild card in the rate environment right now. Force number two, a new, less predictable Fed. Kevin Warsh took over as Fed chair in May, and his approach is fundamentally different from what markets got used to under Powell. He communicates less, provides fewer forward signals, and has said he won't telegraph the Fed's next move. So that unpredictability itself puts upward pressure on rates. Bond investors don't like uncertainty, and they price in risk accordingly. So one analyst put it plainly, until we get some clarity on what Warsh's Fed is going to do, expect markets to continue to price for the worst rate-wise. And then the third force is stagflation signals. The Q2 GDP data showed the economy growing at only 1.5%, well below the 2.1% expectation. At the same time, the headline PCE inflation reading came at 5.1% for the quarter. Slower growth and higher inflation. That's the definition of stagflationary environment, and it puts the Fed in an incredibly difficult spot. They raise rates to fight inflation. They risk tipping growth into contraction. If they hold or cut, they risk letting inflation run hotter. There's no clean answer, and that uncertainty is being priced into mortgage rates every single day. So let's recap the biggest data releases from last month, because this is the information that moved markets. The first was the Fed meeting on July 28th and 29th. The Federal Reserve held rates steady at 3.5% to 3.75% for the fifth consecutive meeting, but this was not a quiet hold. 3 voting members, Hammack, Kashkari, and Logan, dissented and voted to raise rates immediately. That's the most dissents in the hawkish direction since September of 2016. Warsh acknowledged the internal division, calling it a family fight and saying he welcomed the debate. But markets read it as a signal. This Fed is losing patience with above target inflation, and September is very much in play for a hike. Q2 GDP on July 30th, the Bureau of Economic Analysis released the advanced estimate for second quarter growth, 1.5% annualized, down from 2.1% in Q1 and well below the consensus forecast of around 2 to 2.1%. The headline miss, though, masks something important: real final domestic demand. Consumer spending and business investment actually jumped to 3.9%, up sharply from 1.7% in Q1. The drag on GDP came from declining government spending and wider trade deficits. So the underlying consumer economy is actually showing resilience. PCE inflation came out on July 30th. Released the same morning as GDP, the June PCE report showed headline inflation running at 5.1% on a quarterly basis, with the PCE at 3.4%. With core PCE at 3.4%, both still well above the Fed's 2% target. The monthly reading showed some cooling. PCE was down 0.1% month over month in June, helped by energy prices falling as Middle East tensions briefly eased. But July's renewed conflict has almost certainly reversed that energy relief. And then there's unemployment claims that came out July 30th. Those initial jobless claims came in at 197,000 for the week ending July 25th, well below expectations and pointing to a still resilient labor market. The Fed is watching this closely. A strong job market removes one argument for holding off on rate hikes. Now let's tie all of this and what it means for the real estate market. Now, according to the National Association of Realtors, existing home sales in June fell 2.4% month over month to an annualized rate of 4.09 million units. Sales volumes remain near 3-decade lows, and yet the median existing home price hit an all-time record of $440,600, up 1.8% year over year, marking the 36th consecutive month of annual price increases. This is a market of contradictions. Nobody's buying and prices are still going up. But why? Supply. Inventory edged up to 1.56 million units, representing about 4.6 months of supply. Well, that sounds like improvement because it is, but a balanced market typically requires 5 to 6 months, and we're just not there yet. And the rate lock-in effect is still keeping would-be sellers on the sidelines. Trading a 3% mortgage for a 6.7% mortgage is a hard sell no matter who is ready to move. So new home sales are holding up a bit better. Builders have been aggressive with buy downs and incentives to move their products. The median home price of a new home sold in June was $398,300, notably below the existing home median, reflecting the discounts builders are offering to get deals done. But even the new construction pipeline is showing strain. Unsold new homes on the market have climbed near levels last seen in late 2007. So the bottom line is that prices are holding steady, sales are low, inventory is improving but still constrained, and affordability remains the central talent. So this is the most important part of this video, is the data and the events on the calendar that will determine where rates go from here. So on August 7th, we have the July jobs report. This is the first major market mover of August. A strong report, let's say 150,000 plus jobs added with stable unemployment, increases the probability of a September rate hike and likely pushes mortgage rates higher. A weak report gives the Fed a reason to pause, which could bring rates down. So we will want to watch this closely. On August 12th, we have July CPI. This is the consumer price index for July, and it drops mid-month. With oil prices jumping more than 20% again in July after Middle East conflict resumed, inflation is widely expected to reaccelerate. A hot number here, anything above 3.5% or 4% year over year, is likely to push mortgage rates towards 7% and beyond. And then on August 25th, we have the July PCE report, and this is the Fed's preferred inflation gauge. This is released just 2 days before Jackson Hole and will set the tone for Warsh's keynote address. If PCE comes in hotter than expected, then all eyes will be on Wyoming. And then we've got August 27th to the 29th, which is the Jackson Hole Economic Symposium. And this is a big one. Fed Chair Kevin Warsh will deliver his keynote address on the Federal Reserve's annual policy retreat in Wyoming. And the entire mortgage market is going to be hanging on his every word. Warsh said his speech is still a blank piece of paper, and he's been deliberately unpredictable. Historically, Jackson Hole speeches have been used to signal major policy shifts. For example, in 2025, Powell used it to open the door to rate cuts. In 2026, Warsh could use it to signal the opposite. A hawkish speech here virtually locks in a September rate hike and would likely send rates surging. A more measured tone could stabilize or even pull rates slightly lower. And then we've got September 16th, which is the next FMOC meeting. Markets are currently pricing roughly a 41 to 61% probability of a rate hike at the September meeting, and that number has been moving daily based on incoming data. If the Fed raises the federal funds rate by 25 basis points in September, mortgage rates could move meaningfully higher, potentially pushing the 30-year into the upper sevens before the end of the year. But the longer-term forecasts from Fannie Mae and the MBA still call for the 30-year to settle between 6.2% and 6.5% by year-end. But those forecasts were made before the July data and the three-member dissent. With each new hot inflation print, that optimistic scenario gets harder to defend. So here's where we're at right now. Rates are pushing towards 7%. Inflation is stubbornly elevated, and the Fed is divided. And the biggest month of policy signals that what we've seen all year is playing out right now in real time over the next 30 days. So what does this mean if you are buying a home or you're a borrower? It means that this is not the time to make assumptions. It means locking your rate when you're under contract rather than floating, because a single CPI report or a Jackson Hole speech could add half a point to your rate before your closing date. It means calling your lender and understanding exactly what your lock window looks like. This is not the time to try to play the market and see if you can get any gains. If you're waiting on the sidelines for rates to drop back to 5%, well, I want you to have an honest conversation with yourself about how long you're willing to wait, because that data right now is not showing that it's going to happen in 2026. If this video has helped you make sense of any of this, please like it, share it, subscribe, and drop your questions. I will answer them all. I'll see you at the next video.